Welcome, 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 everybody. Welcome to this edition of Crashes and Taxes. I am your host for this podcast, Rebecca Walser. I hope that you're taking me with you to work out or to run, or if you're watching, we do run a video of me doing the podcast in the office. So please feel free to watch as a video if you'd like to do that. We're going to pick up on what we talked about really last week, which was tax policy. And I want to talk specifically this time about how this tax policy is really changing as one of the biggest changes that we've had in the history of estate tax planning is now happening with this administration. So I want to make that very, very clear, because there are millions and millions of trusts out there that are going to be impacted by this new administration's tax regime. So I'm talking specifically now about this administration wanting to eliminate the 1014 step up at death. I talked on this very briefly, but I want to explain how this actually works and a little bit more in depth so that you can understand and prepare yourself, because everybody has planned to basically allow family or whoever their beneficiaries are, their heirs after their death, to inherit their assets at what we call a step up at death. And that is what is getting eliminated. So let me explain. Under section, there's two basically basis definitions in the IRC, Internal Revenue Code. The first one is 1015, and that is what we call a substitution basis or a carryover basis, which I will explain to you. And then there's 1014, which is an inherited basis that's stepped up at death. So what is the 1015? Let's explain. Let's pretend that I have $1 million and I want to use up some of my lifetime gift exemption while I'm alive, giving it to some of my kids. Let's just pretend. And so let's say I was going to give $1 million to $1 million in stocks to my two kids, let's just say. Well, if I were to gift that during my lifetime, let's say that I bought it, it's all Apple stock, for example, and let's say that I bought Apple for $300,000 and it has grown over the years to now be worth $1 million. If I gift that to my children, they inherit that gift at its carryover basis. In other words, it's too good of a deal, right, to get a gift from mom that's worth $1 million when you have to pay no tax on it. No, if you could inherit Apple stock from a family member without having to pay the tax of the increase in the value from when that family member bought it, then nobody would ever pay any kind of taxes. They would just gift property to their family. Their family would not pay the tax. Then that family would gift property back to them, and we'd all be just exchanging property, and none of us would be paying any kind of taxes. So clearly it doesn't work that way. When you gift property to somebody, they take the basis, we call it stepping into your shoes. So if I had a basis of $300,000 in Apple and I gifted its value of $1 million to two children, they would step into my shoes and they basically would also inherit a $300,000 basis. So let's say that they were young and not so smart, because most kids in long-term don't really do really well with long-term planning. So I might think that Apple has the longest runway and want to hold, right? But they're going to do what kids do, which is they're going to sell and get their $1 million. But when they sell for $1 million, they're going to have a gain that they have to pay taxes on of $700,000 because their basis is only $300 and the stock sells at $1 million. So they have a $700,000 long-term capital gain that they will need to pay capital gains taxes on. So that's how gifting during your lifetime works. There's a special rule, though, that overwrites 1015, and that is section 1014. And section 1014 says when somebody inherits property from somebody through their death. So in other words, if I'm giving out my assets after I am passed away, either through a trust, through a will, through various third-party contract terms, if I'm giving away the property at that time, then 1014 kicks in, and 1014 says, oh, this person has passed away, so now the people that inherit this asset get it at the fair market value. So if I was to pass away and gift my $1 million to two children through my death, they would then inherit that $1 million of Apple at $1 million, and even if they sold all of it, they would pay not a penny in capital gains taxes. So there is an entire industry, cottage industry, and estate planning that leverages and utilizes this step up at death through revocable trusts. So when you use a revocable trust, the government doesn't look at the trust as a separate legal entity. As long as the grantor of that trust, which is the creator of the trust, as long as the grantor of the trust is alive, and as long as they stay alive, the IRS looks through that trust and looks to that grantor to report the actual trust assets. So let's go back to my $1 million Apple example. Let's say I create a revocable trust and I transfer my $1 million of Apple to the revocable trust. The revocable trust right then at that moment is getting that Apple stock at a $300,000 basis, and the basis to the trust is $300,000. But if I'm alive for another, hopefully another many years, decades and decades, if I'm alive for many more years, that trust is not reporting anything. They're not doing a 1041 trust tax return. All of the return information is going to come to my personal 1040, and it's going to be reported on my 1040. So let's say that I'm making money inside the trust. I am reporting that on my personal return. I am not doing a separate trust return. Now, what happens is I gifted the Apple stock to the trust, but because I am the grantor of the trust, the IRS does not look at that as what we call a completed gift. It is a gift with a problem. It's a defective gift. And we're intentionally making it a defective gift because we don't want the 1015 basis to be the ultimate basis. Ultimately, we want the trust's basis to be determined at the point of death. So what happens is when I create a revocable trust, I put my $1 million of Apple that has a $300,000 basis that's transferred into the trust. That is the basis. And if I were, as the director or as the grantor, or if the trustee was to go in and sell Apple, the trust would have to recognize, meaning my personal return would have to recognize the gain and the actual capital tax, the capital gain tax on the gain if we were to sell the Apple while I remained alive. But if Apple stays in there, and let's say it grows and now it's worth $2 million at my death, the trust, because it was an incompleted, defective, intentionally defective gift, what happens is the gift gets completed at my death. No longer can I revoke the trust because I am no longer alive. And the act of death makes the trust become irrevocable and gives the Apple stock, it makes it a completed gift. And because the gift got completed through death, 1014 kicks in and we get the Apple stock basis of its then fair market value of now $2 million. So again, the trust would be able to sell that and distribute the proceeds to the beneficiaries with zero capital gains taxes. This is how we've had the estate planning world work for decades. And this administration is ending the 1014 step up at death. So now if I die with $2 million, the trust will have to recognize a gain of 1.7 million, pay the capital gain tax rate on that 1.7 million before that can be distributed out to the beneficiaries. So you can see that this is a complete sea change of basically transferring wealth down to the next generations. And I think this was very intentionally done because we are on the cusp in the next 7 years of 65 million baby boomers retiring. And we know as people retire, they set up their estate plans, they set up their tax strategy. And this is a way for this administration and the federal government to grab a lot more wealth from the wealth transfer that is going to go from the baby boomers through to Gen X and Gen Y and Gen Z. So we're in the middle of the largest wealth transfer that we've ever seen in the history of our country. And this administration is stepping up right in time to basically take more of it away. This means we have to do some new types of planning and we have to deal with this. What this administration also wanted to do was reduce the estate tax overall percentage. I think that they've given that up right now because they're already increasing capital gains tax rates, as we talked about on the last podcast. They're trying to really put people in a corner by getting rid of the step up at death, which we just talked about, by increasing capital gains taxes across the board for everybody above 15%, but making them almost over 43% for people that are making $1 million or more a year. And eventually we'll see the estate tax exemption, lifetime exemption come down, as well as the estate tax go up. I project that in the next 20 years, we'll be looking at a $2 million exemption per person maximum, $4 million if you're married. And I expect the estate tax itself will be in somewhere in the 60 to 70% range based on the taxing that we have from the retirement baby boomers. So I hope this was another tax centric, but I think that these are really important right now because this step up at death means millions and millions of trusts need to be rewritten because they will be completely ineffective with using the tax scheme of 1014 that will no longer be available. So that's pretty much it for you guys for this week, Crashes in Taxes. I hope that was really helpful. If you have a trust or if you know anyone who has a trust that's relying on revocable trust, you need to let them know this is happening. This is very important information. All right, until the next time, you guys take care.